focus on the proposals.
Okay, well,
I'm starting. Your 10 minutes.
Thank you. Well, hearing you talk about $10 billion we've overpaid and all the profitability of refiners, we can skip that. But I do want to point out, since we haven't talked since Exxon and Torrance came back online, that we do have a situation now where the laws of supply and demand in the last month really seem to have been suspended in the state of California, because we've, up until yesterday, or maybe 2 days ago, have been seeing the highest retail price in the nation in California, but we also have the lowest spot price for gasoline until a run on the market just yesterday. That's a really abnormal situation, and it suggests, while we're looking at inventory reforms right now, supply reforms, that something else is really sour in the market. If you go to number 3, you'll see the gap we've seen traditionally between the spot price and the retail gas price is usually 88 cents. But in the end of August, early August, end of July, we've been paying $1.50 more, $1.50 gap. That's a huge, huge premium. And it goes back to what the Air Resources Board was talking about, how the spot price is not correlated with the retail price. If we go to the next slide, number 4, the cause of that problem isn't a supply shortage. We're doing really well on supplies. The cause of that problem is undue excessive market power in the hands of 4 refiners that control 80% of the market, or 2 refiners that happen to control 56% of the market, roughly. Next slide. And the turning point of all this really was this 2013 Tesoro purchase of BP's assets, when we saw not just the refinery go into Tesoro's hands, but also the retail gas stations of the low-priced Arco brand. We've talked in other meetings about some of this, but the gap we've seen at Arco branded stations with the unbranded independent sector at that retail level, the gap in pricing is a big driver of these higher prices in California. Number 6, please. So when we talk about what we can do on supply, I'm just bringing back an investor call quote from the new owner of PBF, which, by the way, I think has done a great job of running that Exxon refinery flat out. But he did say in a recent investor call, bottom line is there's too much clean product, and the only way you can solve this problem is reducing the amount of clean product that you make. And he was talking, I think, on a national level, not just about California, but this is definitely the mentality of this market. And it is both a supply side and a pricing, a retail pricing problem. So if you go to the next slide, please, let's take on this one idea of inventory requirements, minimum inventory requirements. And Cody's done a good job of pulling together some of the research. I just want to go through it really quickly. The International Energy Agency requires all member states, including California, to have a certain strategic reserve. These are the requirements, and 6 states, we went through this a little bit before, and I think Amy even knows more than we do, but 6 states met their obligation of a refined gasoline reserve in Europe, Greece, Italy, Luxembourg, Sweden, Turkey, and United Kingdom, by having industry maintain those requirements, but setting a standard by which industry would. And many EIA nations hold their stocks in this form of refined product, such as gasoline. If you go to the next slide, please. The U.S. Has had refined products released in the wake of Hurricane Katrina, and it helped to moderate the problems we had. There was a previous release, because we are a member nation, but we keep our reserves in the form of crude, not refined products, in 1991 during the first Gulf War. Next slide, please. And clearly, in the case of natural disaster, it makes a difference. In the EU, the member states have these requirements. They have to hold 90 days of average daily imports, or 61 days of average daily inland consumption, whichever of the 2 quantities is greater. And there's some flexibility about how that happens. And about 1/3 of the supply must be in specific stocks. The next slide, please. And in the wake of Sandy, something I didn't know, but Cody found, President Obama actually created this Northeast Regional Petroleum Product Reserve. So that is a gasoline supply reserve in New York Harbor, Boston, and Maine to mitigate against problems in the natural disaster. Next slide, please. So overall, we talked a little bit about the one problem that has to be identified. I think if you were to recommend low minimum inventories, which is something we certainly think can ward against a price spike, the degree really depends upon, whether you believe refiners will abuse the situation because they have too much market share. But the one question that really remains is, what kind of tanks would have to be built in order to meet whatever requirement that is set by the state. But it does no doubt create a cushion to prevent either supply manipulation or ward against perennially low inventories, and to mitigate against price spikes. Disaster relief, obviously, in the case of a major earthquake, is obviously another big part of this. The con side of it, which is something that until recently, I hadn't taken as seriously as I do now, is look, these inventory levels may no longer be the driver of higher gas prices and gas price spikes. If you go to the next slide, what we may be seeing is something like the situation now, where if you look since June, our supplies in this blue inventory range are up through the roof, and yet San Francisco is still paying the highest gas price in America. Until recently, California was paying the highest gas price in America. Our wholesale gas prices, the spot market gas prices where the refiners have been selling to each other, are the cheapest. And just yesterday, they went up about 10 cents. And in fact, I'm just getting a note from Cody, LA spot price just jumped another 9 cents, so 19 cents up in the spot price. And the reason being reported by Opus is that Tesoro, which has this market power on both the refinery and the pricing side, bought up the spot market yesterday, and PBF bought up some more product yesterday as well, which is really kind of interesting given the fact that PBS says it's flooding the market with product and has too much clean product. So we see the spot market being bought up by the major refiners. If inventories are growing and prices are remaining high, supply side solutions are not going to necessarily be a help. They may be a help mitigating a very large, quick, sudden, high price spike, but overall, you have to match that against the dislocation that these proposals cause, which goes to the next slide. California's forward purchasing of gasoline. Again, it's a very small amount of gas you're putting on the market. Will it make a difference when you have this type of market power? Next slide, please. The CARB pressure relief valve. You are creating a fungible gas supply that could increase supplies in times of shortage. It could mitigate against imports. Could mitigate, against price spikes. However, again, there is both the problem that you're giving a policy reward to polluters if it's ever utilized, but in addition, you're fighting against a market that may actually abuse that pressure relief valve in a way that we haven't contemplated because of that excessive market share. So if you go to the next slide, I think our big problem with what we're seeing right now in this market, we've gotten Exxon back online. We have inventory levels higher than the average, and yet we're still seeing I guess in San Francisco, a very high spread with America, the highest price in the nation. And in California, it's dropping a bit. It went from about a 60 or 70 cent spread to about a 50-cent spread. But now refiners are buying up the spot market, literally as we speak, of this gasoline that they produce. So it doesn't appear to be a problem simply with supplies. I would propose that if this committee is going to make some recommendations, it should consider dealing with the real problem here, which is market power. And that would mean limiting refiners to owning just one refinery in California. That would make a difference. Making refiners divest from retail gas stations to spread control to more players. One of the big problems we've identified in this and other meetings is this huge spread, 30 to 40 cent spread between branded and unbranded prices. It's the same gas. Refiners in Southern California that control 80% of the stations through branded contracts are pumping up the price and keeping it artificially high. If we prevented refiners from using that contractual power to inflate branded prices, we would see more price moderation. And so what I propose is that these proposals, while they can help, I think, all three of them, with a price spike and mitigating against price spike, they're an awful lot of trouble when you realize that market power is now driving higher prices overall and higher profits overall, and something the industry is used to. And we'd ask that you consider going after market power directly, because that is the problem here. And I'm under it by 30 seconds. Thank you very much.
Thanks, Jamie. I will make a comment right away that as limited as the committee's power is, we at least do have the ability to we have ability to recommend whatever we want, but
that's right,
I think recommendations that could be actually acted on within the state of California are probably more welcome. And I'm pretty sure that forcing divestiture of refineries is not something that the state of California would pull off.
I think legally it is something the state of California can do. It is something politically that probably is just as difficult as any of the other things you're going to propose.
But it does raise an interesting point, which is the Federal Trade Commission did a very detailed analysis of the California gasoline market when they reviewed the BP Tesoro asset sale. And I'm pretty sure, and I'll have to go back and look at that, they assumed a free-flowing market for imports at that time. And I'm pretty sure their analysis said that that would be a buffer against the exercise of market power. And it would be interesting to get one of their experts in to talk about whether the data for the last 18 months is consistent with their ex-ante analysis of what could happen in California. My impression is it's not, but it would be interesting to know their view.
Can I also add that the Attorney General of California had a condition on that acquisition that BP would supply its ARCO branded gas stations at the lowest price, with the lowest price gas, and we may have exceeded the period by which that contract, by which that agreement is still in force. But clearly, ARCO, Tesoro is selling branded ARCO dealers at that 30 to 40 cent price above what it's selling to the lowest price independent stations. And so a lot of what was assumed in that deal or even required in that deal are conditions that have changed.
Kathleen?
I don't want to address that, but I do want to mention that the assumption, in addition to imports, was that excess production capacity now in the system would also function to mitigate price spikes.
Yeah, I think more generally, returning to that analysis and how effectively it describes where we are today would be very interesting. I think even technically it is possible for the government to rescind or to revisit a merger after the fact if they find that even if they chose not to oppose it at the time, it has increased market power.
Two things. One is, if that FTC study is publicly available, I'd love to see it.
I'm pretty sure that there is some FTC documentation. I'm not sure that it's all publicly available, but there's some record. Or maybe, yeah, no, this is FTC. There should be.
I believe the FTC did issue an explanation that went along with its decision not to challenge that merger, and that is publicly available. It was sort of part of their press release. And when we have our meeting, when we talk about some of these market power issues, that would be one of the more recent kind of overviews of what we thought would happen, prior to the 2015 experience. So it's possibly a good one to examine: did it work the way people thought it would work?
Thank you. And then my second point is that when you look at a lot of the volatility that we've seen in this market, it's been around the ExxonMobil Torrance refinery, right? And that could be for any number of reasons, but it seems to be singled out. I would say that that's a single refinery. ExxonMobil didn't have a system out here. It had to divest one of the two refineries it owned in California. And in my view, a network that has more than one refinery in it has synergies. The refineries can send materials back and forth to help reduce their costs. They can share their labor costs, and they can share feedstocks and the like. And so a problem in one refinery in a multi-refinery system is not as bad as it is by a single standalone refinery.
Yeah, and I think that is the perennial trade-off when examining concentration in a market, that there are economies of scale in production, and when you don't allow firms to grow large, they don't get the economies of scale, but they also don't get the market power. How that nets out depends on, obviously, we don't think that one firm should be producing all the gasoline for California, even if there are some additional economies of scale. On the other hand, we wouldn't want every refinery to have a throughput of 10,000 barrels or something. So where does that trade off is, I think, the critical point. I think the Federal Trade Commission, when they did their analysis, came to the conclusion that the benefits outweighed the potential risks of market power from the BP asset transfer, but it would be interesting to know if their analysis is consistent with what's happened. Even more interesting to know if whoever made those decisions and what the experts thought at the time would still believe those were good decisions.
I would say also that on the production side, that production agreements and even exchange agreements, particularly production agreements, seem to have been what got Exxon through this with Tesoro. So on the production side, Exxon got the benefit of its competitors' capacity. However, what's, I think, really jumping out from the time we've seen Exxon come back online is this hold that these refiners have over the branded retail sector and what they can do to pricing in that sector. That's a historic anomaly. We went back, as you recall, and found that 4 cents was the traditional spread between branded, unbranded prices, and now it is consistently 30 cents or more, and that's been going on since for a year now.
Yeah, Jamie, you raised that, and this has come up, and maybe Dave will show data that are inconsistent with this, but when you raised that like 6 months ago, I went back and looked at the data, and my recollection is that if you look at the spike from in 2015, it is all at the spot level, and that retail margins average pretty much where they normally were. But Dave, that's not what you found?
And so I'd be happy to put that up, after lunch when we've got the time. But yeah, basically what we're seeing is that there was a fairly dramatic increase in retail margins in 15 and 16 versus prior periods on an annual average basis.
And that is ex-tax retail price minus the spot price?
Yes.
Okay. Yeah, I'd be interested in seeing that. Jim Sweeney.
Jamie, can you talk a little bit more about the proposal to make refiners divest from retail stations to spread control? My impression is that refiners still can enter, even if they don't own any retail stations, they can have a contractual relationship to sell at a given price for branded versus unbranded, that they would still have just as much control if they did not own any of the retail stations. And in addition, you can have some areas, more isolated areas, where one proprietor has nothing to do with the oil company, but one proprietor can own all or most of the retail gasoline stations and still have market power there. So could you explain how your point of making refiners divest would make any real difference?
Well, what we're seeing is particularly the DTW price, the dealer tank wagon price. The refiner has through dealer tank wagon price and obviously selling at the branded rack, but generally through the dealer tank wagon price, the ability to set by setting that price on its branded stations 30 to 40 cents higher than what it's selling through a super jobber to the unbranded independent sector, which it does sell to. It's artificially inflating the street price at the vast majority of gas stations, which are branded, particularly in Southern California, where we have a huge 80% of them are branded. So by having a contractual right to charge a price that's 30 cents higher or 40 cents higher in some cases than what you're charging to the lowest, to Costco, to an independent, to an unbranded station, that can go anywhere, that has the ability to vote with its feet and go to any super job or any refiner or any importer. You are artificially keeping the street price higher because it's not only the price that's dominant in most of the gas stations, but the unbranded sector will gravitate towards a higher price that's closer to the branded price in terms of what it's charging the public. So I guess what I'm saying is this contractual power in the last year since we identified this, I think at your first meeting in June, when we just started to see it in the unbranded, branded rack price. But since then, we've seen an even bigger differential because we've gotten DTW prices. And then we talked about these dark deals or special deals, which are below even the unbranded rack. And if you look at that spread, that's where we get that 30 to 40 cent difference. So what I'm really saying is that when the refiners can have this moments of strong supply, which we have seen over even with Exxon Torrance out, the prices have remained high because they have this way of overcharging their branded stations through these contracts, which the branded stations have to pay, and the public then gets that added price added on to us. And so it is if we did have a divestiture of branded stations, or we required contracts that had some more price equity between the branded and unbranded sector, like what we've seen in the past, the 4 to 5 cent spread, or making clear that perhaps that's already illegal under Robinson-Patman or other federal antitrust laws that are little enforced, that we would have the ability to prevent refiners in times of strong supply and strong inventories from artificially pumping up the price at their branded stations to keep gas prices higher than the market would ordinarily price them if they didn't have that contractual power.
It sounds, I didn't hear a word you said that had anything to do with who actually owns the retail stations. Everything you said had to do with the nature of the contracts that they have. So you would want a contract where you would somehow limit the price that could be charged for branding services as sort of a state price regulation?
You could either limit the amount of branded contracts that a refiner or can have, the amount of branded gas stations in a given area, or you could look at the contents of that contract and say, if you have branded contracts, your prices need to be based on a spread that's no greater than X cents from the unbranded. Now, that would strike an economist, of course, as downright socialist. But the reality is, it is that control refiners are exhibiting over their branded stations, not the unbranded contracts, not the and the independent sales they have. That is the cause of this big price disparity we see. So I think you could limit in any given, particularly in a rural area, how many stations an owner could have. But I don't think that's the real cause of the problem we're seeing and we're trying to address. I think the bigger problem is the nature of that branded station market saturation, and the refiners being able to dictate prices at 80% of the branded gas stations in Southern California.
Okay, we got two more questions from Amy and Dave. I'm just going to say I don't think that strikes the economists as socialist. It might strike economists as not clear that they will lower the DTW as much as raise the other price if you set a maximum margin between the two.
Well, that's if you believe markets don't work based on supply and demand. I mean,
No, that's if you believe in incentives. If you set a maximum margin between the two, they either have to lower the DTW or raise the price to the discounters, and it's not at all obvious that they would
if we
lower the DTW.
If we know that 88 cents is the traditional add-on from a spot price to a retail price.
Jamie, you're starting out by assuming they have a whole lot of market power, and then you're assuming that this would cause it to suddenly crumble rather than have actually.
I guess what I'm trying to do is that's why I say divestiture in terms of not allowing ownership more than a certain percentage of branded contracts is one way to go, because that limits their market power. That's why I said economists are really anathema to the other issue, which I understand. But either way, it's getting at a very specific problem, which is the control the refiners are exerting through those types of contracts at the pump, through the price, not through supply.
Okay, we're running way over, so I'm going to give it to Amy and Dave, and then we got a break for lunch.
I just want to make a quick comment, Jamie, so you don't, to unconfuse the record. The reason inventories can be high now and there's no response to gasoline prices from the inventories if there's market power, is that there's no mechanism to force refiners to release the inventory into the market. Presumably, if the state had an inventory system, an emergency inventory system, there would be a trigger to it where the state would announce that it would like the release of XYZ amount of the inventory into the market, and that would have a price impact, as it does in the IEA system, and as it's seeming to work, hopefully in the Northeast. Now, I did want to point out, having just been at the National Petroleum Council meetings, that the DOE will be coming out, I think in the next few weeks, with a new proposal for improving the SPR system with some allocations that need to be made because pipelines have been reversed and so forth in the United States, and that they are considering what could be done for expanding the portion of the U.S. national system that involves gasoline stocks. So just sharing that with the public, that even at the federal level, people are thinking that increasing the government's ability to access gasoline inventories is becoming a more important tool, even federally.
Okay, Dave, last comment, and then we'll go to lunch.
2 points. The first one is retail gasoline prices in Southern California continue to decrease according to EIA stats. I can see they're down 8 cents a gallon over the last few weeks, while the national average for regular unleaded is flat. That's the first point. The second point is I don't know if there's consumer disbenefit here in the disparity between DTW and wholesale prices. I know I can go to the Costco I go to is in Tustin, and last time I was there was $2.25, and the Chevron that's catty corner around the street is about $2.85. So there was a 60-cent spread between the two. And now, presumably, the Chevron customers are not unhappy paying more, or else they'd be at Costco.
Okay, we're going to break until 1 o'clock. Why don't we make it 1:10?